This is Jerry over at Wealth Dynamics. Thank you for tuning in this Friday night at our Wealth Creation course. We come to you live every Friday, 6 p.m. Alaska time. That's 9 p.m. Central time to talk to you about financial knowledge, making money, keeping money, and multiplying it. And that's what we're talking to you about tonight. Now, this is part 2 of our legacy series. Last week, we talked about estate planning. We talked about trusts. We talked about wills, living wills, avoiding taxes, avoiding probate. And there's really 2 ways to leave a legacy. All right, so number 1 is when you die, you can set your estate and your legacy up to live on past you. You can also set up a legacy while you're alive. And that's what we're going to talk about right now. So we're going to talk about how to save for your children and really dive into that topic first as we kind of go through the different plans, how you can structure them, etc. But that's going to be our topic. Now, a little bit of my story. I've been in the industry of finance for going on 8 years now. I've worked with every type of client possible. And one of the things I love doing is I love helping parents, grandparents, set up accounts for their kids, for their grandkids to set them up for the future. And I want to talk to you tonight about how to do that. But part of my story is the way I was brought up. We never had that. So I grew up, I call it upper, lower class. And basically, we didn't have college accounts. We didn't have savings accounts. When I graduated, there was no money waiting for me. In Alaska, we have what's called the permanent fund dividend. I think I only got that once in my entire life. All the other times it went to groceries and whatever else. So basically, I didn't grow up from a legacy of finances and wealth and financial literacy. I had to really figure that out on myself. And part of the mindset barrier that I want to help you overcome tonight before we dive into this is if you're like me where you weren't raised that way, meaning you didn't have money, people didn't give you anything, it doesn't mean you shouldn't do it for your kids. Okay, just because it happened to you and you didn't like it doesn't mean you have to repeat the cycle and do it to someone else. Okay, sometimes your parents are great. My parents are awesome at certain things. Finances weren't one of them. That's okay. They didn't do a great job with that. I learned from it. I'm not saying that because I had a bad experience, now my kids have to go through it too. That's dumb. Okay, so get that mindset out first and then open up to, all right, well, how could I start planning for this? How could I set my kids up? What if it only took a couple $100 a month? Like the money you spend on coffee, you could spend on your kid also, and you can have that set to where they're financially set the rest of their lives. Okay, so we're talking about how to save for your children. You can also do this for grandchildren, nieces, nephews, cousins, siblings. So if you aren't a parent, it doesn't mean you can't help someone that's younger than you with finances. This applies to anybody. So here we go. When we're saving for kids, there's different ways people go about it. So some of the things you're going to see. Now, more old school, you have savings bonds. So savings bonds, those are basically government bonds, as you can see here. That's going to be more of an old school way of doing it. These were maybe in the 1940s and 50s, really popular. Into the 60s, 70s, and the 80s, they started phasing out. And that was when banks were paying just gigantic interest rates. So the bonds started phasing out, and then people went towards CDs. Okay, so a government bond or a savings bond, it's a government savings program issued by the government. A CD is issued by a bank. So if you remember, like some of our grandparents maybe set up CDs for us, and you had these CDs that when they came to maturity, you were able to take that money and go do with it as you pleased. So a CD is a committed savings deposit with a bank. Okay, the key word here is committed. Okay, CDs, and then you had your standard savings account. So you have just regular, bank savings account at your bank or at your credit union. Nothing special about it. As we start moving more towards present time, you're going to see a couple times tonight, and you may have already heard of this term. It's called a Coverdell ESA. So Coverdell ESA stands for Coverdell Educational Savings Account. That is basically a federally regulated college savings plan. It can only be used for college. And then next we have what's called a 529. So a 529 is a state level savings program. You've probably heard of a 529 plan before. The biggest difference, the federal government regulates the Coverdell. They do have some regulation over the 529, but most of that's happening at the state level. And then you have this one. This one sounds like the boots with the fur. You get the UGMA and the UTMA plan. So this is more of a non-qualified account that can be transferred to your beneficiaries. And that's basically like just putting money away that's going to get transferred down the road. It's almost like a trust account. So it doesn't have to be used for college. We're going to talk about those tonight as well. And then lastly, we have a new product that we're releasing. It's not really new. It's 170 years old, but it's new for us. We're just selling it and offering it to our clients. The Sacred Account Junior. So this is a high early cash value dividend paying whole life insurance policy that you can set up for your kids, your grandkids, your sibling, your cousin, your niece, your nephew, whoever that might be, and be able to put money aside for them. So these are the different terms that we're going to cover tonight, and I want to dive through each of them. Most people today, when you look at savings, most people today do a Coverdell, a 529, or just a bank account. Savings bonds really are kind of a way of the past. Not many people use those anymore. And then we look at some of the other stuff, the UGMA. I used to set these up for my clients back in the day. Not many people actually know about that account. So that one's not super commonly used. And then we do have the Sacred Account Junior, which again, not many people know about this as an option. So you're probably used to hearing about this guy, this guy, this guy, and this guy. These ones, like I said, this one's a little older. This one is not as well known. And then same with this one. All right. So those are the different types of accounts.